Welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today we have a lot to cover, from the surge in mortgage delinquencies to updates in provincial planning rules. So, let's dive right in. Our first topic today is a concerning trend in the mortgage market in Ontario. According to a recent report from Equifax Canada, the number of mortgages in severe delinquency has surged by almost 67% in Ontario. This is a significant increase and reflects the broader economic challenges many homeowners are facing. The report highlights that the high cost of living and rising unemployment, which now stands at 6.4%, are key factors driving this increase in delinquency rates. As of the end of the second quarter of 2024, over 3,000 mortgages in Ontario were in severe delinquency. These delinquent mortgages amount to a whopping $1.3 billion in balance. To put this in perspective, the current mortgage balance delinquency rate in Ontario is 0.16%, the highest it has been since 2014. Nationally, however, delinquency rates are still below pre-pandemic levels, sitting at 0.16% compared to 0.17% in 2019. Rebecca Oakes, Vice President of Advanced Analytics at Equifax Canada, noted that while inflation is stabilizing and interest rates are starting to reduce, the rising unemployment rate has offset some of these positive developments, leading to increased financial stress for many homeowners. This financial stress is not just affecting current homeowners, but also young adults who are increasingly living with their parents or grandparents. Equifax reports that almost one-third of Canadian households now have an adult child living at home, a number that jumps to 32.8% in Ontario. The high cost of living, soaring rent prices, and unattainable home prices are contributing to this trend. Young Canadians are finding it increasingly difficult to secure job opportunities that would allow them to move out and afford their own homes. First-time homebuyers are also feeling the pinch. The report indicates that the number of first-time buyers continues to decline compared to pre-pandemic levels. Those who do manage to buy are facing loans exceeding $410,000, forcing many to opt for longer amortization terms, sometimes exceeding 25 years. High interest rates are also impacting those renewing their mortgages. In the second quarter of 2024, 15% of mortgage renewals experienced a substantial increase of over $300 per month. This is almost double the 8% of renewals that saw similar increases in 2019. In Ontario and British Columbia, this figure is even higher, hitting 20%. Many homeowners are opting to extend their mortgage amortization terms to manage these higher costs. Rebecca Oakes pointed out that those who secured homes in 2020 and 2021 with low interest rates and high loan amounts could face significant challenges. Even with recent rate cuts, these individuals may need to prepare for substantial increases in monthly payments and extended amortization terms. Overall, Equifax described the mortgage market in the second quarter of 2024 as strained due to high interest rates. However, there was a silver lining as new mortgage originations grew by 21.3%, a notable improvement from the previous year's low numbers. Alberta, in particular, saw a substantial rise in new mortgages, driven largely by interprovincial migration. Even though home sales dropped in the second quarter, the average mortgage loan amounts grew by 6.1% compared to the same period in 2023. This indicates that while fewer homes are being sold, the value of those being purchased is higher. That's it for our first segment today. Stay tuned as we dive into more updates and insights affecting the Ontario real estate market. Our next topic focuses on the recent updates to Ontario's provincial planning rules. The Ontario government has released a new set of land use planning rules for municipalities, which build on the Cutting Red Tape to Build More Homes Act. Paul Calandra, Minister of Municipal Affairs and Housing, outlined the key changes in the 2024 Ontario Provincial Planning Statement, which will take effect on October 20th, 2024. Minister Calandra emphasized the importance of these updates at the annual Association of Municipalities of Ontario conference. He said, "The new provincial planning statement recognizes that municipalities know best where and what types of homes are needed to address the unprecedented population growth we have seen. It gives them the tools and flexibility they need to get it done. One of the key directives in the new planning rules is to develop more homes in areas close to major transit stations. This includes subway, GO, light rail, and rapid transit bus stations. Additionally, the new rules encourage building more homes on underused low-density lands like shopping plazas, malls, and brownfields. John D. Michel, Chief Executive Officer of the Toronto Regional Real Estate Board, commented on the new directives. He stated, "These lands are often in highly desirable areas of a city or town that require additional municipal support to make development projects feasible. By turning underused lands into housing, we can meet our supply targets faster and help more families attain a place to call home." DiMichele also pointed out that the condensed and more streamlined provincial planning statement will make it easier and less costly for planning officials to adopt the new rules into their planning documents. Other significant changes in the new planning rules include encouraging the construction of a broader range of housing options for students and seniors. The rules also advocate for more integrated planning for future growth that maximizes public investment. For example, they promote better coordination between municipalities and school boards. Overall, these updates aim to address the pressing need for more housing in Ontario by providing municipalities with the flexibility and tools they need to meet the growing demand. The focus on transit-oriented development and the utilization of underused lands are seen as crucial steps in achieving these goals. Our next topic is the recent drop in existing home and condominium sales across Ontario and other major Canadian cities. The Bank of Canada's recent rate cut was expected to boost the housing market, but it appears that buyers are still holding out for more reductions. The Greater Toronto Area saw 6,213 home sales in June, a 16.4% drop compared to the 7,429 sales reported in June 2023, according to the Toronto Regional Real Estate Board. New listings, however, rose to 17,964, a year-over-year increase of 12.3%. The average selling price of $162 to $167 was down by 1.6% from a year ago. Jennifer Pierce, president of the Toronto Regional Real Estate Board, noted that while the Bank of Canada's rate cut last month provided some initial relief for homeowners and home buyers, the June sales results suggest that multiple rate cuts will be needed before buyers move off the sidelines. She emphasized that the board believes several reductions will be necessary for sales volume to rebound. Jason Mercer, chief market analyst for the board, added that the Greater Toronto Area housing market is currently well supplied, giving recent home buyers substantial choice and negotiating power on price. He noted that as sales pick up alongside lower borrowing costs, elevated inventory levels should help mitigate against a quick run-up in selling prices. Calgary also saw a significant drop in home sales in June, with a 12.8% decrease from the same month in 2023. New listings in Calgary decreased by 3.6%, while inventory rose by 9.2%, according to the Calgary Real Estate Board. Condo sales in Calgary were down 8% for June, largely due to a scarcity of properties priced under $300,000. Anne-Marie Lurie, the board's chief economist, stated that the pullback in sales reflects supply challenges in the lower price ranges, ultimately limiting sales activity. Despite the decline, 40% of the homes sold went for over the asking price, and the unadjusted benchmark home price rose 9% over last June to $608,000. The biggest price increases were seen in the northeast and east sections of Calgary. Vancouver has also become a buyer's market, with inventory levels not seen since the spring of 2019. The Greater Vancouver Realtors reported 2,418 sales in June, a 19.1% decrease from the 2,988 sales a year earlier. The sales numbers were 23.6% below the 10-year seasonal average. Andrew Liss, Director of Economics and Data Analytics for the Greater Vancouver Realtors, observed that buyers appear hesitant to transact in typical volumes for this time of year, while sellers remain keen to bring their properties to market. This dynamic is bringing inventory levels up to a healthy range, providing buyers with more selection and driving all market segments toward balanced conditions. Liss also mentioned that, like Toronto Realtors, Vancouver agents are hopeful the Bank of Canada will cut its interest rate again. The central bank is set to release its next announcement on July 24th. He noted that a potential rate cut would tilt the market further in favor of buyers, even if the boost to affordability is modest. However, June's lower than normal transaction volume suggests many buyers remain hesitant, allowing inventory to accumulate and keeping a lid on upward price pressure across market segments. Montreal, Canada's second-largest city, was a bright spot in June, with a 6.4% increase in residential sales in the greater metropolitan area compared to the same month last year, according to the Quebec Professional Association of Real Estate Brokers. Meanwhile, the Royal Bank of Canada issued a report suggesting that while the housing market has a long way to go to reach affordability, it is headed in the right direction, with rate cuts driving that movement. The bank expects a full 2 percentage point cut in the policy rate to 3% by the end of 2025, which will bring down long-term rates as well, albeit to a lesser extent. Less than half of Millennials and Generation Z think homeownership is possible in Ontario, according to a recent survey by Royal LePage. Conducted by Hill and Knowlton, the survey polled 2,280 Canadians between July 22 and July 31, 2024. The results paint a stark picture of the challenges facing young potential homeowners in the province. The survey revealed that 84% of Canadians aged 18 to 38, which includes Generation Z and young millennials, believe that owning a home is a worthwhile investment. Furthermore, 74% said that homeownership is a lifetime priority. However, when focusing on Ontario, only 47% of respondents believe that owning a home is an achievable goal. In contrast, 27% said that homeownership is unachievable, and 26% were unsure. Nationally, the sentiment is slightly more optimistic, with 54% of respondents believing that homeownership is attainable. Yet, 26% are still unsure, and 20% do not think it is achievable at all. These figures highlight the significant barriers young Canadians face when it comes to entering the housing market, particularly in Ontario. Despite these challenges, the next generation of potential homebuyers is willing to make financial sacrifices to achieve their dream. Nearly half, or 47% of those planning to purchase a home, are regularly saving a portion of their earnings for a down payment. Additionally, 42% are diligently paying their loans and bills to ensure a good credit rating. Some 34% are reducing discretionary spending to save more, and 30% are living with family to minimize rent costs and save for a down payment. Phil Soper, Chief Executive Officer and President of Royal LePage, commented on these findings, stating that the youngest cohort of homebuyers in Canada faces numerous barriers on their path to ownership. Though the cost of borrowing has begun to come down, chronic supply shortages have kept housing prices from dropping even as demand softened under the weight of high interest rates, Soper said. Despite these hurdles, the next generation of homebuyers remains committed to their pursuit of owning real estate and are remarkably optimistic that they can make their dream a reality. Interestingly, while high home prices remain a significant barrier for first-time buyers, the real estate market has cooled somewhat over the summer. This has led to more homes selling for under the asking price across the Greater Toronto Area. For instance, in Mississauga, prices dropped 5.5% from June 2024 to July 2024. Brampton saw one of the most significant declines, with an average sale price of just over $1 million in July. Halton Region experienced a 17.6% decrease in sales month over month in July, with 543 homes sold. For those looking for a more affordable way to enter the housing market, some communities in the Greater Toronto Area had median prices of less than $550,000 from January to June of this year. The cheapest median sold price was in Toronto's East York neighborhood, standing at $485,000, with 63 total sales during the first half of the year. Overall, the survey underscores the financial challenges and sacrifices that young Canadians are willing to make in order to achieve homeownership. While the path to owning a home is fraught with obstacles, particularly in Ontario, the commitment and optimism of the next generation of homebuyers remain strong. Our final topic today addresses a situation that, while still rare, is becoming more of a concern for homeowners: what to do when your mortgage renewal is declined. Though interest rates may be falling, many homeowners are still experiencing rate shock upon renewal, and in some cases, getting turned away by their lender. Here are some steps to take when your renewal application is denied. If you have a mortgage, you probably know that you need to renew it every so often, typically every 2 to 5 years depending on the term you choose, until you pay it off. What you might not realize, however, is that your lender is under no obligation to renew that mortgage contract when your term is up. Of course, banks do not go around arbitrarily declining mortgage renewals. In most cases, if you have been diligently making your mortgage payments in full and on time, they want to keep your business. But when lenders have reason to believe that your risk levels have changed in a bad way, for example, you have missed payments, had a significant change in income, debt, or credit score, or they think you will not be able to afford your monthly carrying costs due to interest rate hikes, your mortgage renewal could be declined. While still quite rare, more than 99.8% of residential mortgage holders are currently in good standing according to the Canadian Bankers Association. There are fears that renewal declines could start to become more commonplace. That is because the borrowers who took out mortgages in 2021 and early 2022, when house prices were close to their peak and rates were very low, are facing rate shock renewals with median payment increases of 22% this year, nearly 25% in 2025, and more than 30% in 2026, the Bank of Canada estimates. Moreover, according to a survey from Mortgage Professionals Canada, nearly a quarter, or 23%, of mortgage holders say even a small rate increase will cause them to have trouble making payments. So what can you do if your mortgage renewal is declined? Here are some options. First, speak to your current lender. It is important to find out why you were declined. There might be an easy fix. For example, if the reason is a drop in your credit score, but you have been making all your debt payments on time, check your credit reports for any errors. If your credit score has, in fact, taken a hit, ask your lender if there are any conditions under which it would reconsider and approve the renewal, such as getting a co-signer who has good credit. Next, refer to the Canadian Mortgage Charter. Anticipating that borrowers may need support to afford their mortgages when renewing at higher interest rates, the federal government recently collaborated with financial institutions to develop the Canadian Mortgage Charter. The charter outlines the types of relief you can expect from your bank that can help you be approved for renewal, such as a temporary extension in amortization to lower your monthly mortgage payments, the ability to make lump sum payments to avoid negative amortization, and waiving any fees or penalties that would normally be attached to such provisions. While the charter is not law, meaning banks do not have to comply, the government is strongly encouraging them to do so, and says it will closely monitor their implementation of the relief measures. If your lender will not play ball, you can make a complaint on the Financial Consumer Agency of Canada website. Another measure under the Canadian Mortgage Charter is that Canadian banks and other federally regulated financial institutions are no longer required to apply the stress test if you switch lenders at renewal and have a Canada Mortgage and Housing Corporation insured or high-ratio mortgage. That means you can qualify with a new lender based on market interest rates rather than the minimum qualifying rate, which adds a buffer of 2% or uses a floor rate of 5.25%, whichever is higher. Theoretically, this should improve your chances of finding another bank willing to refinance your mortgage if your current lender declines renewal. Of course, whatever reason is behind your current lender's reluctance to renew your contract could also warn off other banks. Consulting a mortgage broker is another viable option. Mortgage brokers know which banks and other lenders are most likely to refinance a mortgage for borrowers in your situation, and they will negotiate on your behalf, which can save you time, stress, and money. Plus, brokers can suggest ways to present yourself to new lenders in the best light. For example, paying off or restructuring outstanding credit if your total debt service ratio is too high, or getting a cosigner if necessary. If you or your mortgage broker cannot find a large bank or credit union that will refinance your mortgage, smaller financial institutions, trust companies, and mortgage investment companies, referred to as B lenders, are your next best option. They are often more willing than A lenders to work with borrowers who have more debt or lower credit scores. If you cannot get approved by a B lender, you can try a private lender, but it will cost you. Private lenders charge the highest interest rates and many are not licensed, so there is more risk involved. While not ideal, selling may be your best option when you cannot renew or refinance your mortgage. If you do not take action to sell so you can pay off your mortgage balance, your current lender can repossess your home and rent it out or sell it without your involvement. Note that under the Canadian Mortgage Charter, banks are expected to waive any prepayment penalties when owners sell a primary residence because they are struggling financially. If your mortgage is up for renewal in the coming year, do not take a wait-and-see approach. Be proactive by checking your credit score and debt-to-income ratio and using a mortgage calculator to determine what your new carrying costs may be. With enough advance notice, you can pinpoint any potential pitfalls and take steps to correct them, so your lender will not have any reason to decline your mortgage renewal. That wraps up our episode for today. I hope you found these insights helpful as we navigate the complex landscape of Ontario's mortgage and real estate market. Stay tuned for our next episode, where we will continue to bring you the latest trends and updates. Until then, this is Steve Hamoan signing off. Have a great day.